Hello, everyone. Welcome back to Perfect Spiral Capital. My name is Luke Tatum. I'm an authorized infinite banking concept practitioner. And today, what I'd like to talk about is this idea that somehow universal life policies, there's several varieties of these, are more appropriate to use for infinite banking than whole life policies. This is a very, very common thing you'll see online if you start to look into the infinite banking world. Infinite banking has kind of been co-opted by a lot of people out there. It's really irritating in a certain sense because Nelson Nash is the one who, named the idea. He wrote his excellent book, which you'll see behind me, Becoming Your Own Banker. I reread that book every year. And he's talking about using whole life insurance policies. There's a lot of really good reasons to use whole life insurance. However, there's a very popular idea that universal life, you'll see UL, guaranteed universal life, GUL, you'll see IUL, indexed universal life, you'll see VUL, variable universal life. And there's many more varieties than that, but the idea that it's somehow more appropriate to use variable or indexed or basic universal life, some flavor of universal life instead of whole life. What difference does it make? It's all life insurance, right? Well, no. That's really not the case. Let's talk a little bit about the underlying concept. A whole life insurance policy is an agreement. It's considered to be a unilateral contract. Unilateral means one-sided. Uni meaning one, lateral meaning sided. It's one-sided in your favor, you, the consumer, the purchaser of the policy. Once that policy is issued, as long as you pay the pre-agreed premiums that are in that document, then you have that policy. It can't be taken away from you. You'll see what's called an incontestability clause. So the insurance company has 2 years to figure out if there was something that you, say, lied about on your application. And once that 2 years has passed, even if you misrepresented your application for life insurance, then you're good. You're in the clear. So it's very much one-sided in your favor. And I'm not encouraging you to lie on your life insurance application, quite the opposite. But I'm just saying that's an example of how this is a one-sided thing in your favor. Okay, so let's say it's a $500 a month payment. Well, that's a lot of money compared to term insurance or what have you. If all we have is just the most generic person in mind, say a 45-year-old male or something, it's okay, it's a lot of money, fine. Because it's going to be enforced, and I'm talking about a modern insurance policy here, it's a to age 121 life insurance policy. So if at any point between the age at which you got the policy and the age of 121, you pass away, which is extremely likely, then the life insurance company is on the hook to pay the death benefit at that time. And in a whole life policy, if you do not tell the death benefit to reduce in some way, it's going to not reduce. It's in all likelihood going to be going up if we're talking about a dividend paying whole life insurance policy. There are some whole life policies out there that don't pay dividends, so it's important that we're not talking about that here. My policies increase on a contractually guaranteed basis every single day. That's the cash value. And then the death benefit is actually going up every year also. It's quite phenomenal. And this goes into the structure of why you would do that. But the point that I need to make here is that as long as you pay the premium, that's it. That's the one requirement for you to continue to have this whole life policy. It's in your favor. You've shifted your risk of passing away and not being able to produce income for your family, your surviving family members, your spouse, your children. You've shifted all of that risk to the insurance company. And that's the end of it. That's the whole idea. This is the oldest form of life insurance by quite a long shot, and it's been around for a long time, hundreds of years now. They used to call it ordinary life insurance because that's all there was for a long period of time. What's the difference between whole life and universal life? Universal life doesn't work that way. You see, whole life is kind of a black box. It's got a lot of inner workings. You don't really get to see how every little component is performing necessarily. It's all kind of rolled into one. The life insurance company has their investment portfolio, which is vastly in favor of corporate bonds, by the way, if you're curious. They manage these long term debt instruments and they create a rate of return, and then they take in premiums in excess of what they expect to pay. And then they use those excess premiums and their returns on their investments to pay dividends. Okay. That's all that is. But it's all kind of together. You don't get to see exactly how well every little component did. The idea comes along in the 80s that you should unbundle this. This is the birth of Universal Life. Universal Life is not an old product by any stretch of the imagination, about 40 years old at this point. Now, the company that created Universal Life in the first place went out of business. There was a whole bunch of allegations with that. That's some interesting history you might want to look into. But it was adopted widely, and there's all kinds of varieties that have come out since then, like we talked about, variable, index, etc. But the idea with Universal Life is that you're going to take the cash value in the policy, and then you are going to say, okay, how much does it cost to continue to have life insurance this year? And they deduct that out. And then they'll look at their investment performance and how it's allocated to your particular policy type. And they'll kind of run their calculations. Oh, okay, your policy grew by whatever. Why does that matter? When you're 30 years old, it doesn't matter very much at all. Life insurance is not expensive when you're 30 years old. You would look at someone who has a whole life policy and laugh at them because they're paying a premium that's orders of magnitude larger than yours if you're a young, healthy person, right? But the problem with term insurance is that it expires after a period of time. Term insurance you might find is a 10-year term or a 20-year term or a 30-year term. Let's say you have a 30-year term policy. Okay, you pay a fixed premium for 30 years and you're insured for 30 years. After 30 years, you're not. Right? Universal Life, you get to keep the policy, but they get to adjust what the cost of the insurance is based on how old you are. So if you live a long time, well, your premium's not so high at age 30. It's not so high at age 40. It's not really that bad, all things considered, at age 50. But if you're making it to 60, 70, 80, 100, 110, if you live a long life, then that term insurance cost is going to go through the roof. Unlike whole life, in a universal life policy, you have not shifted your risks to the insurance company. You can read stories from the New York Times, the Washington Post, Forbes, all of these places. They all have pieces about some individual that has paid life insurance premiums for their whole life. I'm saying whole life, meaning their duration of their life. I'm not talking about the product. They've paid premiums for, let's say, 50 years, 70 years. And then the insurance company sends them a letter and it says, hey, your policy is about to cancel. You need to send us like $20,000 within the next 2 weeks, or we're going to have to cancel your policy. And they're dumbfounded. They haven't thought about that insurance policy in years and years and years, right? Why would they do this? How could they do this? The insurance company is greedy and evil, right? Well, that's what they signed up for, unfortunately, because the cost of the term insurance that goes up every single year has gotten astronomically expensive. So if you don't live very long, maybe universal life is a better move, from the perspective of how much did I have to pay to get a certain death benefit. But why would you plan around that? What I would say is that's a problem. If you want a tool that will definitely at some point collapse on its own terms, that's what universal life fundamentally is. If you pay more premiums than you're required to, if you do various other things, maybe you can prop it up for longer, but again, we don't know the future. So you don't know if that's really a good move or not. Again, on the whole life side, it doesn't matter. They have to pay you. You've already contractually set up this arrangement where they're going to pay the death benefit. Let's go back to universal life again. So since you have this problem with universal life, it is going to cannibalize itself at some point in all likelihood. then what? Well, the clever folks at the insurance carriers came up with this idea. They said, all right, what if we take the investment component of the policy, since we've unbundled it, since it's not just part of the premium, we don't have this one thing. We've now broken it into two parts. You've got the life insurance and you've got the investment part. What if we took the investment part and we put it in the stock market, right? Because people make tons of money in the stock market. Okay, cool. That's what they did. Indexed universal life follows an index, which is going to vary by the insurance company and how it's set up. And then variable universal life is tied to a portfolio of mutual funds. And you get to choose those mutual funds. You get to choose from the menu that's offered. You don't get to choose any mutual fund you'd like. So, in that sense, it's similar to a 401k or something. Okay, what if we could make so much money in the stock market that we can outpace the drastic increase in the cost of the insurance? That's the idea. Fine. But again, the longer you live, the more exponential the growth in the cost of the term insurance is. Also, you will see all these various guarantees and things built into universal life policies like, well, it's never going to go down in value as long as you meet these criteria. And it's never going to go up less than a certain percent. You might see like a 0.5% or something. So it's always going up. It's great. Okay, fine. What happens when the cost of insurance is skyrocketing and the stock market is down? And it's down for multiple years in a row. You are bearing all the risk in this arrangement. If that happens, your policy is at risk, not the insurance company. It's not their money that's tied up in the stock market. It's your money, right? So this is kind of the downside. Whole life insurance companies, mutually owned whole life insurance companies, they're some of the best money managers in the world. They're buying long-term corporate bonds, and they're really good at it because their whole model is that they have to be there to provide death benefits when needed for people. And they've been doing it for over 100 years in a row, many of these companies, some of them for even over 150 years in a row. And they're profitable, paying dividends. They know what they're doing, right? That's through world wars and all kinds of catastrophes in the past. A lot of these companies that are very focused on universal life haven't really been doing that for that long. And so there's a lot of gray area. It's like, what actually happens whenever we have a true financial catastrophe and you're basically stuck with the bag? I don't want your policy to get canceled. I don't want you to pay tons and tons of money in premiums into a policy for years and years and years, and then all of a sudden get a nasty surprise in the mail that is just something you can't deal with. Therefore, you must cancel your policy. One of the other things, this is not tax advice. I'm not a tax advisor, but you need to understand what consequences there are if your policy must be canceled after you've gained a lot of profit inside of one. Well, if your policy cancels after you have a profit, then you've got an income tax liability for all of the gains inside of that contract all at once. So if you're putting lots and lots of money into a stock market-based universal life policy and it cancels when you're 100 years old, well, I don't know. I don't know how big your policy is, but you might owe income tax on $15 million. Do you want that? I don't. And so I just don't feel that it's appropriate for you to take a tool where you have given away none of your risk. You keep all the risk on you. I don't think it's appropriate to use that kind of platform to do infinite banking. Because guess what? Again, if you have $100,000 of cash value in a policy, the stock market does poorly, your cost of insurance is high, but you need to take a policy loan. Okay, what's the cost of insurance? If the cost of insurance for the 1 year is $25,000 and you've already got a loan out for $90,000, policy's not going to make it. It's done. You either have to repay your policy loan to a significant extent or the policy is going to fall apart. It's just that there's a lot of problems with this. And I think that people marketing IULs and VULs, they tend to de-emphasize the negative aspects. It's just something to know. I'm not telling you not to get a universal life policy. I'm just telling you to know what you're buying before you get one. At Perfect Spiral Capital, which is my agency, we do not offer universal life policies at all. We will do term policies. Many term policies are convertible into whole life policies. We're here to do infinite banking, and that's just not appropriate for that. So I hope this video helped. If you have any questions, any questions, especially about a policy that you already have, we're more than happy to review those. Please reach out to us, perfectspiralcapital.com. You can also learn a lot more about whole life, implementing it in your own life, and following our blueprint for financial freedom at betweenthelliesbook.com. Between the Lies is a book that I wrote and also narrated. There's an audiobook version available. Be happy to discuss these things with you, and our agents would be very happy to discuss these things with you. So reach out to us. Let us know how we can help. You'll find all the links in the description box below, and we'll talk to you soon.